All right, so we should be all good right now. So first and foremost, welcome to everybody who's joining up in here right now. Um, I guess a little introduction, really quick, because I do want to just make this mostly about the concepts because I think just based on what we talk about tonight, I think this is literally your foundation for realistically everything moving forward. Trading it's not rocket science. Is it difficult? Absolutely. Is it something that I think most people can actually be successful at? I do. Obviously, there's a couple caveats to that, and I'll get to that in a second. But um, to me, I think a lot of the things that are online, whether it's on Twitter, other Discord groups, anything really, I think it's a lot of it is just too much. And what I mean by that is I think there's a much simpler way, and that's what I'm going to show you here. Um, so to preface all of that, I want to say that I didn't, come up with any of these concepts. This was not me, uh, you know, grinding at the computer for 10 years to finally come to a conclusion that this is exactly how price works and everything like that. I learned this all through someone else. Those videos that I learned from, they're all in our syllabus tab in the group as well. And ultimately, again, do I think this way is better than most other ways? I would say so because listen, I've been in a situation where I was using moving averages, I was using options flow, dark pool data, I was using Bollinger Bands, moving averages, that you name it. I've tried it and it just didn't. It really just didn't click for me in a sense. There were days where I make a ton of money, and then there were days where I lost most of it back, right? So, and I think everybody who's been in the game at one point or another, in trading at least, that you need to find a way to be sustainable and to be able to do this over the long haul in order to be successful, right? I think everybody's immediate thing when you jump into trading and you start pushing buttons is, oh my God, if this goes to here, I'm gonna be rich, right? So you're only really thinking about that one time hit, right? And that's not something that's sustainable. That's not something that's going to really make you money to, for the entirety of your trading career or the rest of your life, right? So you want something that is sustainable, something that's repeatable, something that makes sense to you. And that's why it really wasn't until I was able to combine a lot of these different ideas from the ICT, trading concepts until I finally found myself, wow, this makes sense to me. I can explain this from top to bottom. And I think when I explain it, other people are like, holy shit, this works. Right now, one thing that you're going to see as a member of the group as well, you're going to notice that oftentimes I'm going to say, once you see it, you can't unsee it. Right. So I might show you tonight and might be like, what the fuck is this guy talking about? He's a moron. What are you talking about? Once I see it, what am I supposed to see? When I tell you, and I'm sure that others that have been in the group, other people that are in here currently, who've been around for a little bit, they will be able to tell you that there's no BS to this. And once you do see it, you in fact cannot unsee it because of the level of precision, the repetition behind it, and how it's very easily explained to somebody who is, questioning the ideology, right? So ultimately, I guess, if you were to group me as what kind of trader are you, at this point, and realistically, it's just I read price action. I don't have the moving averages on. I don't use volume. I don't use any of that other stuff. And, I have strong feelings about it, but I'm going to save those for another time. Um, because to me, you do not need any of that whatsoever. I think if you're coming into this group from a perspective of, I've been kind of successful and I just really want to hammer home, maybe one thing that you say could really make that next level leap for me to, help me become more consistently profitable. Or, I needed a little clarity. If you say one thing that makes it make a little more sense to me and I think I can hit it and, start to run with things. Um, and that's ultimately my goal. Look, if you trade another way than me, that's fine. I'm not going to sit here and fight you on it, but I want you to be able to see, just how I go about it, right? That's why I do my, you know, Tim, I don't know if you're writing something on the screen or not, um, but I don't want to, try and say, "Oh, you have to trade like me, you have to do this, you have to do that." I don't think you really have to, but again, if I can say one thing that makes sense to you and you can add that into with what you're already doing, and it makes you, again, jump to that next level of consistency and eventually get to profitability, I think that's a total win for us, right? So, ultimately that is my game plan and working going forward, and really everything that I share with you guys is so that you guys can become independent, consistent, profitable traders down the line. But with that being said, there definitely is a level of desire or work that needs to be done in order for that to be something that is, again, consistent, sustainable, and makes sense. Um, again, I've been there, I've tried all of this stuff. If you are just trying to kind of skate by and really not put in the work, and I'll explain what I mean by putting in the work in a little bit, but if you think this is just you're going to listen once and it's all going to click for you and you're never going to have to do anything ever again, I would probably say that's a pipe dream. I think this is a process just like everything else in life that you need to continuously work at. And do I think that you will have a chance to be profitable at the end of all this? You can ask people in the group who have already done it. There's been some people in here who have been in the group for 6, 8 months already, and they're doing just fine. And when they do pop in, it's just a matter of sharing thoughts or helping somebody else out. So I think the trading chat in itself is a huge tool that you can use, because there are people who are they might not join the lives at night, but a lot of people have been in the position that a lot of the newer traders have been in, and they're there to help. But again, going back to the work ethic part of it, like being at the calls and stuff like that, to me it's paramount, especially when we're just kind of introducing the concepts as a whole. There's really not all that many of them for everybody to learn, but the repetition and practice is really what separates you and gets you to that next level. Um, it took me a while to really get an understanding of this right off the bat. I was teaching myself, watching videos, trying to take notes. The videos themselves are pretty boring and they're long. But I just said to myself, there's no way that I'm going to work. That it's just not happening. And I got to make this where it's a much more consistent and sustainable thing versus, just kind of shooting from the hip like I was in the past, where one week I'd make a ton of money and then the next I'd lose it all or most of it. Can't do that in terms of trading and making this like a serious, another stream of income, I guess you can say. But um, I mean, that's kind of just my rant to kick us off. But from this point on, it's going to be ultimately a just a very basic introduction to literally four concepts, which as time goes on, we're going to get into much deeper length with. But just four concepts that, to me, uh, it's really all I use. There are some interchangeable, facets to them, but uh, really it's four things, and I think these four things will be extremely helpful. Uh, after doing this with a few people, just a couple of days ago, they had said, "Oh my gosh, after we were on the call, I went on some charts and I started to map these out, and it's amazing because you're going to notice that a lot of this stuff just repeats, and if you're able to identify why it would repeat, it's a game changer, right?" So just off the bat, I mean, we could really look at any chart um, and go from there. But just for now, we'll at least start on the Nasdaq, and this way I can kind of explain my thought process on what I think we see next, while also teaching you just a couple basic concepts in the process here. Um, so first and foremost, you know what? Let me go to the blank chart that I have of it, so it makes it a lot more clear for you guys to see. Because, oh, whoops, NQ, and let's come on down here to the December. So, I should also, just say, I guess, I trade predominantly futures at this point. Does that mean that these concepts are not going to work for you? Absolutely not. I chart all of the individual names you can think of, and all of the ideas and um, you know just concepts in general. They play, and I'll show you a bunch of examples after this, just to kind of, I don't want to say prove it, but prove it kind of. Um, but anyways, to me, right here, just looking at this chart, you can come make 1,000 different conclusions just from watching these candlesticks. No volume, no moving averages, nothing, right? So right off the bat, let's say I'm looking at this chart. I've never traded it before. I've never even looked at it from this perspective. The first thing that I always go about doing, especially when looking at the higher time frame, which is automatically my number one. So everything that I do, no matter what I'm trading, I'm starting from the top down. So for example, every Sunday I look first, I'll look at NASDAQ because that's what I predominantly trade. I look right from the top. Let's find out where our liquidity is. And this is the first concept that we talk about. Okay. So definition of liquidity. Uh, essentially, oh shit, free will end in 10 minutes, Ryan. Uh-oh, that's an epic fail.
I can create another one.
Oh, all right,
I
yeah.
put in for an hour and 10 minutes. I don't know why I did that.
All right, you're good. Thanks, dude. But going back to it, the concept of liquidity. To me, if you can get an understanding of liquidity, this is the driving force of the market, and you're going to feel like you almost know what's going to happen before it happens, right? You might say, oh, that sounds crazy. No effing way. That's ridiculous. But just watch. So when you're looking for liquidity, the areas where you can find liquidity or points of liquidity, pools of liquidity, however you want to say it, is you're going to be looking for swing highs and swing lows. So swing highs, okay, and swing lows. And we got a couple more down there as well. Why would we look for swing highs and swing lows when we are trying to identify liquidity? Well, the reason why we would look there is because let's just think about it from a very logical standpoint, right? What had to have happened at this candle for price to drive down the way that it did from this point right here, right? Obviously, there had to be some sort of selling or sellers, right? Okay, so using that idea right there, whether it is hedge funds, whether it is institutions, anybody with funds that can actually drive price in the marketplace. I'm sorry, I cannot drive price. I don't know if any of you guys can, but it's going to take a shit ton of money to do that. Especially trading something like NASDAQ. You never hear somebody get arrested for pumping and dumping NASDAQ, right? It's always them getting arrested for pumping stupid penny stocks and shit, right? So, again, who's driving price? Institutions, hedge funds, big money traders, you name it, right? All of that put together, right? Think about it. If price is going to be moving lower from this point, sellers had to be here, right? And what's something that sellers are not going to be, or I'm sorry, large money, what do you think they're going to go into their trade with to absolutely ensure that they're not going to get, absolutely roasted or margin called on a trade? Yeah, they're going to have a stop loss. So some point above this entry for them to actually drive price lower. And think about it. Do they have the cheat code to actually move price? Hell yeah, they do. Right. So are they putting this stop loss on for any other reason other than just totally protective measures? Boom. Absolutely. Right. No other reason to put stop losses because they know they can drive price. Right. They have the funds to do it. Now, with that being said, we know that when there's pools of liquidity, right, at certain points throughout the market, right, price is typically going to draw to a specific pool of liquidity, whether that is your buy side. So buy side is above, sell side liquidity would be down below. So all the market is doing, and hopefully this statement in itself can resonate with you, but all the market is doing is on an eternal search for liquidity. So it's essentially, if you use the term liquidity as like gasoline to drive a car, right? Without gasoline, car ain't going anywhere, right? So the gasoline for this car, which is price, is liquidity, stop hunts, um, emptying orders out. That way you have that gasoline to actually drive the car and make it work, right? And make it move. So without liquidity, obviously the market doesn't do anything. Think about it. If you've ever heard of the term illiquid, right? You think of, penny stocks or certain options contracts that nobody touches, right? Those things don't move. Why? Because they're not liquid. There's no money going in and out of them. It needs the money to actually move price. And without it, there's there's nothing. The price is going to stay the same. It's going to stick there. You're going to be sitting on it as it does nothing, right? So, with that being said, we know that price is just looking for another pool of liquidity, just over and over again. It's in a constant search, right? So if we look at it from this perspective, all right, we reject from this point, right? We retrace up and we'll get to this part why we rejected here. Because for every single one of these moves, whether it's on this chart on NASDAQ or you write in the chat right now, you tell me a random ticker, I bet you I can give you a very informed reason as to why something happened at that specific point. I don't care what it is. If I didn't look at the stock ever in my life, doesn't matter. I bet you we can go on that, pull it up, and I can give you a very respectable. You might not agree with me because you don't, you might not believe that my concepts are correct or something at that point. Oh, I just saw CCJ. Yeah, we'll pull up CCJ. That's fine. Um, but you'll look at anything, and I bet you I can justify as to why something would have happened at a specific point, right? We can look into video as well. Yeah. Oh, you know what? Let's look into video. You want to look into video right now? Okay. And we'll just use the concept of liquidity because I see that we have 441 left here. We're gonna have to send out another link. Sorry, I might have joined a little too early today, but okay. So here we go. Think about it. Liquidity. What was the first thing that I said about liquidity? Swing highs, swing lows. Okay. Look what happens when price takes out a swing low right here. Boom. I'm going to get to the green boxes too. That's kind of the next step here. But look what happened when we take out swing low. So not only did we take out that swing low right here, we also took out that swing low right here. We also took out that swing low right here, all within that one move. Okay. So check this. Ready? What happens when you take out a swing low? Higher time frame swing lows, which this is a daily, higher time frame swing low, and okay, I'm not even showing you my model yet and how I can incorporate my specific model into this to make it make even more sense. So, um, but here's that move. Okay, now where's our swing high? Swing high here, boom. Okay, took more liquidity. Swing high here, took more liquidity. Look what happens. Sweep, higher time frame swing high. Don't. Why didn't we do that here? Well, here's your giveaway. We made an imbalance, and this is the next concept I'm talking to you guys about, but we made an imbalance up and through previous liquidity. To me, all that tells me there's a continuation going to occur. If we don't make that imbalance up and through, I bet you we're going to reach right above it, and then we're going to dump. We're going to take out all those stop orders, and we're going to puke because now we have the money to do so. Now we got to go find some more liquidity down below. All right. And that's what we're going to see, to me in particular with the video. Not only did we, again, take out higher time frame swing low. Here's your bullish volume imbalance right here. We're going to get to that next, I promise. Sweep the low, and we bounce from that point. Here's your imbalance up and through liquidity. Oh, we have a swing high right here. What happened? Imbalance up and through. That's just telling me there's continuation. What happens here? Sweep high. Did we make an imbalance? Nope. We actually made an imbalance down. Here it is, right here. We also made a bearish breaker, another concept that we'll go over in this group as well. Here, hold on, ready? Here's your red. Boom. Okay. And here's your bullish breaker. So we're going to get into some sort of level of support. But with that being said, there are also a couple more caveats that, again, that as we continuously move through this little lesson here, we're going to get to all of these little boxes and stuff like that. So look first. Oh, Ryan, you just put another one. Gotcha. Okay. Hey, so everybody, if you want, let's just pop over to that other Zoom link really quick because um, this one's gonna kick us out in about 2 minutes.
Is it
So
posted in Discord?
yeah. So it's Ryan had just posted in the Discord under the class schedule tab. All right.
Perfect.
All right. Yeah, I'll pop over there. Sorry, guys. Okay, cool. We're good. Okay. So overall, the concept of liquidity, where is price likely to draw to? Right. We know that the market, and again, this is the first time, so you might say, this dude's fucking crazy, doesn't make any sense. Just now that you have this in the back of your mind, whether it's after we talk about this now, you go on later, whatever, you watch it tomorrow live time, you're going to notice that price tends to draw towards swing highs and swing lows. Is it possible that in your mind you're wrong about which draw on liquidity is? Hell yeah. Today I was wrong on the the first attempt of the silver bullet that we took at 2 o'clock. I was wrong. I thought we were going to go higher. We sliced through the level, but the beauty of these having this structure in terms of where are your levels, where's the draw on liquidity, all of those different things is this trade is so well defined that before you go in one, you're going to know what's your potential loss. So you can automatically justify, does it make sense for me to take this trade or not? To me, it did. The risk reward in this situation that I took earlier today was it wasn't even close. So following getting that first initial one wrong, I took the stop out. I think it was like for 350 bucks. Once we swept liquidity, which I guess I can show you right now. Yeah, I'll show it to you guys anyways. Once we swept liquidity on the higher time frame, where are we? Right here, boom. Okay, so just watch this low. This is the low. This was the trade I took. Hold on, I used the 15-minute to kind of map this trade out. So here we go. Hold the phone here. Okay, boom, right here. So I took the trade off of this imbalance right here with my entry being inside this bullish imbalance, and I'm going to show you these immediately after this. But I took the trade off of that. It should be green one right here, and this is a 15-minute candle, so it didn't immediately rip me out. It kind of bounced a little bit and teased me, but ultimately, immediately following, so I used the open of the candle as my stop out. My stop out was here, so realistically, I risked 6, 7 points for a potential, you know, what was the draw that I was looking for up here. Did that make sense for me to take in that situation? Absolutely. Did it work out? No, it happens, it's a part of the game. But anyways, following the sweep of not only one, two, three swing lows, right? Once we started to kind of bounce back from here, we also had a higher time frame imbalance. And again, I'm going to show you the imbalances in a second. Um, I jumped back in, and not only did I make up for what I lost, but I also uh, I made some money today, which is fantastic, right? And the way that I managed this, did it ultimately get to my my target? No, it didn't. But once for me at least, once I get a specific number, whether that's 10 points, 20 points, I usually use 20 points. So with two contracts, it's 10 points. That's $400 on one contract. Once I get up into that vicinity, I start to slide my trailing stop and profit up pretty aggressively. That way, worst case scenario, my trade's still green, and I'm going to make off of it. And that's something again that I teach in here as well. But just going back to the concepts and just all ideology that I use in order to, come to conclusions, we're actually going to we can use this chart perfectly because this totally makes sense. So now, after I've identified what are the potential draws on liquidity, whether it's above, whether it's below, where is the market most likely to draw to? Right? And again, I use the higher time frame for this. And then as we go down, I'm not trading, I'm not scalping off the 1 hour time frame. I'm using that to kind of overall direct my trade, and then I come down into smaller time frames so that I can really pinpoint and identify entry points. What broker do you use to connect to TradingView? I use Trade of 8. Trade of 8 is a futures platform. Um, I'm not exactly, I don't believe you can trade options directly on TradingView, but you can trade futures, you could trade common shares through different brokers that connect directly through. So you just go to Trading Panel and you pull it up that way. Uh, but anyways, so following identifying where's the market going to draw, right? Is it going to be the swing high or is it going to be the swing low, right? From that point, I immediately start to say, okay, what type of trend, right? A lot of people use the term trend. To me, I just from learning from this guy, can you use the word trend? Sure, it's perfectly fine. It makes sense. I say market structure, okay? So ultimately, I'm looking for what type of market structure or trend that we are currently in, okay? And using that kind of makes it a little bit easier to identify what your draw on liquidity is going to be, right? So, for example, let's use this end of day trade because this was an absolute killer um, on just how it kind of meets the criteria for my model. Okay. So, how do we identify trend, right? To me, we would be in a bullish trend or have a bullish market structure if we were to take out a specific swing high in whatever time frame that you're looking at. So in this particular instance right here, right, we took out the swing high with that price run here, okay? So up until this point, clearly we're in a bullish trend or a bullish market structure, okay? So as everybody knows, at some point or another, this is going to break, right? It's not sustainable if the market just continuously, performed my model. The market would go in one direction only and it would never retrace. And we know that's not the case. So in this particular situation, you can look towards a higher time frame. So for me, I like to use the hourly. And if you see these red lines, these are also hourly swing highs and lows. So that's where I'm really identifying those swing highs. And the reason why I do that is because when we take out higher time frame liquidity, go back over here, higher time frame liquidity, boom, boom, what tends to happen? Reversals. That's where the reversals are coming from. So when we do get those higher time frame sweeps of liquidity, that's when I tend to not play my specific model, but I actually look for the reversal. How can you identify a reversal? You look for some sort of imbalance following a sweep on liquidity. We're going to get to that in a second. But we're talking about just overall, how do we determine the market structure, right? So at this point right here, I don't have to bet you, actually, I know for a fact. Did we take out higher time frame swing high with this move up here? Yep, we did. Right here. Ready? Okay. Boom. All right. And there's the dump, right? We shift market structure, taking out these lows in the process. But Mando, you took the trade to go long in this particular situation. Why would you do that? You knew that we took out a higher time frame swing high. Yes, you're right. But the reason why I took it, and this is a little bit higher of a time frame idea, and maybe not the best idea on a Monday, but to me, my higher time frame draw on liquidity, where I think price is going to go before anything else, is I think we are going to 16,257.75. So I'm really not looking for downside until we get a sweep of that level. When we get a sweep of that level, my mindset, my bias of being bullish right now, is it really bullish? I'm only looking for 200 more points. Is it crazy to think that we don't get 200 more points? No. Why? We have buy side liquidity resting right above here, right? Let's go up. Let's fill up the tank on gasoline so that we can drive price back down below, right? Everybody's complaining, oh, we haven't had any pullback in so long. What the hell? Blah, blah, blah. Well, here's the draw on liquidity in my eyes, right? And the whole entire way up, if we go back to that initial chart that I was showing, you saw the tweets that I had pinned on there. And to me, all I was doing was targeting, boom, okay, we hit this one. Now what? Oh, we made an imbalance up and through. Okay, I'm sticking in it. We're going to go higher. Oh, we took this one out here. Okay, what next? Oh, we made an imbalance up and through it. I'm chilling. Boom. Until we make some sort of imbalance to the downside, there's no reason for me to believe that we're going to move down. And that's why I've identified this strong liquidity, and I'm sticking with it until we see some sort of imbalance down on a higher time frame like we've seen right here. But anyways, going back to this. So once we take out this swing low, right? This swing low, why would I point it to this candle specifically? Okay. Well, what was the start of the run that took out these highs right here and even the high that we mentioned previously over here? Okay. Well, it was from that low right here to this high right here, right? Fair enough. So the way that I would have it on my chart at that point would be, ooh, and this is why I bring out the Fibonacci's. I don't trade using Fibonacci, but I use it to map the range. And the reason why I do that is because within a range, there's two specific, or I guess three really, three specific places that you can look or consider when you're looking into getting into some sort of trade, right? So in a bullish trend like we were in right here, you have your low to high. That's your price run that took it. Now, above 50% of this gain, you can think about it as a premium, right? So if you're in a bullish range and you're buying above that 50%, you're technically overpaying, right? And why do I say that? Look, if you know what the entirety of the range is from 0 to 100 and you're buying up in here, what is your potential risk reward in terms of this range? Let's say we buy it at, 25% of the range, right? That means we only have 25% in potential profit while risking 75% of the entire range as our stop loss. That doesn't make sense, right? In terms of risk reward, that really it doesn't add up, right? So now how about this? Below 50%, this would be technically our discount, right? So look, even if we are wrong in this situation, our risk is nowhere near the potential reward for this specific scenario, right? Look, my entry off of from today's losing trade, right? 70%, right? So I risked, it really wasn't even 30% of the range because it was just below this imbalance right here. Again, I'm gonna show you guys how to do those two right here. Hold on, let me slide this bar over so I can make it green. Okay. So if my entry is off 50% or the middle of this bullish imbalance, and my stop loss is below the opening of the candle, right? My risk in that situation is peanuts in comparison to what my potential reward could have been on that trade. And if it were to play out the way that I wanted it to, right? I've shown examples of where, I'm buying that red candle in anticipation for things to kind of get going in the other direction and get going quickly, right? I don't like to sit in these things. So if I don't think price can get into it, wick up and get off, I pretty much kick it to the curb. And if you wanted to see an example like that, just check it out. I post them on Twitter, but you could also check out like Instagram. I only put videos on there so you could see the executions that I go through. And you'll notice that it's pretty much the same thing over and over again. Okay. So whatever, obviously trade didn't work out. That's fine. But we swept some lows in the process. So just like, we identify a bullish trend by taking out swing highs, we would identify a bearish trend from taking out swing lows. So we have multiple lows swept with that price run down. So how would I identify this range? Just go over here to your fib from high to low. Here's your retracement back into 50%. Here's a bearish imbalance, and there's your dump down through. So this is a perfect example of the Mando model that I've been posting on Twitter and on YouTube and such. This is it right here. But before I get more into that, let me just explain to you what an imbalance would be. And sorry if this is really boring, but a lot of this stuff I don't know like a fun way to really teach it. It's just basic foundation concepts that I think once you get a good grasp of, it's going to it'll be fun when you're actually making trades and making money off of it. But so anyways, so if you look at this down close candle right here, I'm going to delete all this other stuff just for now so you guys can see it. So what is one thing that you notice about this down close candle in comparison to, I don't know, any of these other down close candles in this entire run? Well, let's look. Okay, we have a wick down to here. We have a wick up here. We got a wick here. We got a wick up through here. We have a wick here, closed in over on this side. But hold on, ready? From right here to here, ready? There's no wick crossing on either side of that candle, right? So we would view this as a bearish imbalance. Why bearish? Well, price is moving down. So that's the idea behind it, right? And the imbalance is taking place inside this rectangle right here. So inside this range on this specific candle, it's not, sometimes you get huge ones, sometimes you get relatively small ones like we got here. But let's look, see? So from within this region, so at 44.50 down to 42.75, right? Very small. There is a sell side imbalance, buy side inefficiency. So our expectation in this specific instance is when price retraces back up into this imbalance, it's going to act as some sort of a resistance, right? I would even prefer to use like the term like trampoline. We want price to hit it and we want it to reject and move quickly off of that. Okay. Why? What's the reasoning for that? Well, if there is some sort of imbalance in price at a specific range, think about it. There needs to be quite a bit of orders to come through into this vicinity rather quickly to not only fill this imbalance, but also make its way back above, right? We still are in a bearish trend. So again, for every, imbalance that we would create, I just throw on our little, that little rectangle on, whatever you're charting with, you can put it on there, but it's just going to look just like that. So that's our first form of imbalance right there. And this is, if you want the technical term for it, it's a fair value gap. And in this case, it's a bearish fair value gap. So we'll notice that price eventually does find a bottom. Why does price find a bottom right here? We took out liquidity, right? We took out swing lows in the process. So it would make sense for a bounce at this point, all right? So we have our range set from high to low, right? Lows taken out, remember. So it is a bearish market structure or a bearish trend. And we're looking at a 15-minute. We're not even looking at, a 1, a 5. You can use this on any time frame, no matter. But always, first and foremost, you always want to just have those higher time frame levels. Much more pinpoint. Deep fucking YOLO has a question. Do you chart fair value gap on 15s? What time frame? Yeah, so hold on before we get into anything else. I don't know. Can you guys see like the top bar of my screen right now where you see like NQ and there's like a
Yeah.
bunch of symbols? Yeah, so all of the symbols,
Yep.
different time frames. I'm struggling right now because I have this zoom bar. Hold on. If I just move it down just a little bit, I'll be able to see. Okay. So just to go through my specific layouts, and I map these imbalances on every time frame. And I don't have them on the same chart because then it would just be so cluttered and garbage. And but again, I start, like I said before, weekly. Do these weekly levels always come into play during, a specific day? Not necessarily. We're really not near the high of the week or of last week, and we're not near the low of last week or any other substantial swing high or low, really. So, the weekly to me at this point it's not that not that important at this exact moment. Then I have my daily chart. Then I have my hourly chart. Then I have my 30-minute chart. And now, which do I really look at? Well, I look at the hourly, and the hourly is very nice because to me, it is giving me like some sort of directional bias. I'll have my overall bias coming from the daily time frame, and then I use the hourly as I guess a more pinpoint area to look specifically. But I'm not, I'm scalping contracts. Oftentimes my trades don't last more than about 20 minutes. So the way that I'm looking at it is, okay, if I'm looking at, an hourly time frame, am I going to be able to scalp, 0 DT contracts, for example? Probably not, right? It's going to take too long. Theta is going to chew you up. You don't, it's just not going to be beneficial. So how will we make that make sense? Okay, we can come down to a smaller time frame using the framework from that hourly chart. So again, if we're in a bullish market structure or a trend on the hourly time frame, and I see that we're getting into a pretty, or I guess an area of interest, maybe a discount. So below that 50% bullish imbalance, price gets into that. My expectation is that at some point in that hour, we're probably going to leave that level and move higher. Now, let me just go back down into a 15, or I use the 5 as well. Today was a very choppy, shitty day, so I wasn't really looking at a smaller time frame for that reason. But I'll come down into a smaller time frame and I'll identify where can I get an entry on this. And at that point, I just wait for a specific imbalance and in discount and look to play it from there. So I do, I for the most part chart them on the 5 minute, but when you get a day like today where it's very choppy and not too many imbalances are forming on the 5 minute time frame, I tend to move a little higher and look towards the 15. But um, but again, in short here, you have your bearish market structure. So from high to low, why? We took out multiple swing lows in the process. I then look for that retracement back up into discount. So your discount is going to look like this on a bearish price trend, right? So here's 50% of the range, equilibrium. Discount is above 50%. So we're looking for a bearish imbalance above 50% in this specific range, right? Well, price pops right up into 50%. Here's your 15-minute bearish fair value gap. Price clicks up into it. Does it wick a little higher? Yeah, that's why I used the open of the candle as my stop loss. And here's your meltdown. Where would our target be in this specific situation? Down to the lows. We have a bearish, structure. Our expectation from this point would be that price would sweep a new low, kind of continue on lower until we sweep some higher time frame for form of liquidity to give us that reversal, right? If we were to look at an hourly chart, I bet you we didn't take out anything um, on this move down right here. But this is a perfect play out of my model in a sense where all I'm looking for, and this is on any time frame, doesn't matter. This is whether I'm trading a 15-minute NASDAQ chart, whether I'm swing trading AMD. Hold on, let me come over because I have this one all mapped out. Whether I, again, pull over right here, right here, it's all the same, right? Bullish market structure. Why? Swept swing high right here with what price run? That price run. Price retraces down where discount below 50%. Where specifically a discount bullish imbalance. Why not any of these imbalances here? I look for them specifically in the golden pocket, 62 to 79%. Why do I look in the golden pocket? What's giving me the best reward for the potential risk that I'm taking on in this trade? Deeper into discount, right? So if I can find an imbalance at that 79, sign me up because I'm taking that trade 10 times out of 10, right? Okay, so in this particular instance, with AMD here specifically, I was swing trading this, so luckily it didn't really matter because it didn't come down any lower. But let's take a look. Oh, whoops.
What's up, Pop? What's up, Bubba? How you doing? How we doing, Bubba? Tired. Tired? Why? Long
Oh,
day.
I'm muting D dot. But so anyways, now let's just look at the criteria for this trade as well, right? Bullish market structure shift, took out highs, set your range, your retracement, and this is on a daily time frame. So this obviously took a while, but price retraced back down into where discount, bullish imbalance, and we took out a higher time frame low, swept the low, and take off. Okay, you'll see I have these stated, and if you don't want to believe that these have been on the chart, if you just type in at Mando Trading with the money sign AMD, you're going to see a tweet that says it's back in September, almost at long entry. And when you got down to long entry, why would I use this as my stop loss? Swing trading commons, it's the risk isn't as much as it would be for me personally. Swing trading an options contract, so I will give it a little bit of breathing room to take out swing low. What would happen if we took out that swing low? Bearish market structure shift. My expectation would be that we'd sweep the higher time frame, but we would just bounce to, what do they call that? Uh, Swing high, or I'm sorry, a bear market rally or whatever. So we would just be bouncing to get smacked. Do you enter right at open or wait a few minutes? Yeah, so I do not trade until 10 a.m. Do I think that I could trade prior to that? Yes, but when you're trading something like NASDAQ or SPX, the risk is a little bit more enhanced there. So I've just noticed from my own, my past at least, that trading that you can make a shit ton of money, but you could also start out the day pretty shitty. Even if you end up being right, but seeing yourself down, a couple $100 before or literally as the market's opening is a terrible feeling. So I try to avoid that. So I realistically, the times that I'm totally focused is from 10 to 11 a.m. and 2 to 3 p.m. Eastern. In between, are there trades to be had? Yes, and sometimes I do trade in between those times, but to me, the most high probability times, for whatever reason, I wish I could tell you. I don't know if it's some sort of clearinghouse that's taking place at that time, or what it is, but the setups during those times are typically the most clean, and that's why I'm looking at those specific times. Um, let's see. Yeah, no problem, Mo. So again, this is my model in itself right here. So ultimately, I'm looking for swing highs and swing lows. So identify liquidity. From that point, I'll map my range. So I use the fib tool to map the range. Now, this is a question that I've gotten in the past. What if you don't have a bullish imbalance down here? Would you just trade it off of 79%? I've seen it work. I personally don't do it. I need the added extra little layer of this bullish imbalance down here in discount. If I don't have that, I'm likely not going to just trade off the fibs. I need to see the actual imbalance form. And just to kind of go back and show you guys, like, for example, I guess you could say the precision that's involved here. Here's your bullish fair value gap or bullish imbalance. So ready, here's your wick, body, wick. Look on both sides. So inside that, ready, see it? There's no wick on either side of the candle. Okay, right? So we kept that. Obviously, we didn't get back to it until a couple months later, but how about this one? Gap up. How do we view gaps using these concepts? If we're gapping up, what that's showing me is a sense of urgency to move higher. So I view that gap as a level of support, right? Everybody just wants to talk about, oh, this gap needs to fill, this gap needs to do. Why? Does it really? Does it have to happen immediately? No. You can go back on any chart and look up. I bet you see gaps all over the place that are unfilled, especially on some of these shitty penny stock or mid cap names. Uh, price doesn't necessarily have to immediately go back into any sort of gap. In this case, it does. Here's your bullish volume imbalance and take off. Just for reference so that you guys can see it in action, but that's another type of imbalance. So the two types of imbalances are fair value gaps, where you get the candles. So you wick, body, wick, no wicks on either side of this specific range. That is our bullish fair value gap. Same thing on the other side of it. You can get a bearish fair value gap where you get a down close candle, no wicks on either side. But you also have the volume imbalances. So if we were to gap up, to me, that's showing me some sort of urgency to move higher. So I would use that level as a green box or support level. And if we're to gap down, to me, that's showing me that there is some sort of urgency to move lower. And I would use that gap area as a level of resistance moving forward. So again, ultimately, you have liquidity, you have your market structure, you have your imbalances, and then really just your trade mapping from that point. You take shares or options for stocks. When I trade options, the only contracts that I trade is SPX, which is 10x leverage on SPY. So if I'm swing sharing something, it's typically shares. I think theta is just a fucked up way to screw people over in retail, to be honest with you. So I don't really fuck around with swinging options at this point, especially when, let's say you hold something over the weekend, who the fuck knows who's going to war next, and then you're totally shit out of luck, right? You have zero control over that contract. So that's why I don't really mess around too much with swing trading options. But yes, I trade futures, and I trade if I'm trading options, it's typically SPX, and that's about it. So what else? Oh, I get, here you go again, just mapping a trade. So I already used the AMD example. Let's just use one more, and we're running out of time here again. So ready, where is it? Right, I don't know. We can, again, if anybody wants to look at anything specific, just pop it in here. Oh, here's an example of higher time frame liquidity really quickly. Probably seen me post about this on Twitter before, but right here. Here's Disney. Always tweet first, unlike a lot of these people on Twitter, because they don't. They just pretend they did, and they pretend they call it, but then you have people who actually do. Disney sweeps COVID lows. What is a COVID low? A higher time frame pool of liquidity. We swept that low, bouncy, and goodbye. We held the bullish breaker on the retracement, and we've taken off ever since. So those shares from 78 to 95. Let's see another example here. Palantir just completed. Palantir, they were up insane. Let's see. Ready? Okay, here it is. Hold on. I updated it, so let me redo the update. Hold on. Okay. bullish market structure shift. All right, here's 2 in a row actually. Okay, bullish market structure shift down into 50% of a bullish range. There's your bullish volume imbalance or gap up. Price retraces into it, takes off, completes the model. Where would my stop loss be? Below this current imbalance right here. Where would my take profit be? Above the swing high. It's as simple as that. Everything is mapped out to as precisely as possible as a result of that. And if you want to look, this is why I totally believe that there's an algorithm. Look how perfect this is. You can't make it up, right? What else? I got a few more that I'll just go through really quickly. I see there's some chats up there that we can look through as well. Coinbase, this one just completed, but I'll show you again. It's just clockwork. Again, it's a staple of the algorithm that delivers price. So here's your swing low. What do we do when we took out that swing low? Took out higher time frame liquidity. There's your run to highs. There's your retracement back down where? Discount, where specifically a discount bullish imbalance. Price takes off up through the high. Done. What else? There's a few more. Oh, we can look at Netflix because Netflix is about to do it. Hold on, ready? Let's go over to the weekly really quickly because it's much more clear on the weekly because there's not a million candles, just a few. Okay, ready? Ready? Swing low. Why this low? Well, we took out this high with that price run. Here's your retracement back down where? Discount, bullish imbalance, off the 0.79. Now what would our stop loss be? Below the open of this candle right here. Never came in jeopardy. Bounce, where's our take profit? 485 above swing high. Why? When we take a higher time frame liquidity, what do we look for? Reversals, right? So this is the thing, and this is why I'm not really looking for all that much left in NASDAQ because we've already had names like Amazon, Microsoft, NVIDIA. They've already taken out that higher time frame swing high. So to me, it's reasonable to think that some of those names would pull back at this point. But at this point, we still have Netflix, which is pretty damn close. We're about $5 away. We have Apple, which is like $6 away. We have Tesla. Tesla's actually quite a bit away. Google's about $2 away. So there's a lot of names that are pretty damn close. And I think if those do move on and take out their swing highs respectively, I think that'll be enough for NASDAQ to get to my 16,257 target. And from there, kind of, justify everything and justify a pretty substantial pullback at that point as well. Just one more thing and then I'll get to those chats. But here we go, right here. Because I have all these tweets loaded on here. So, I can go through them very quickly, but I guess the ideology behind each one of these. Okay, so from this point, showtime has arrived. Bears better come correct. Why would I say something like that? Well, okay, what's our current market structure in this run right here? What do we do? Are we bullish or bearish? Well, we took out a swing low in the process. Okay, so that to me, that would indicate a bearish trend or bearish market structure. Okay, so we would look from what was the high that kind of started that run. I mean, we can look at it from any perspective, but let's look at this one first because I actually have it annotated. So from high to low right there, just for now, where do we retrace into? Discount, bearish imbalance right here. Done. Okay. So from this point, I just say, okay, slide on over. Okay. Bearish market structure shift, took out a low. Price retraces where? Back into your discount. Is there a bearish imbalance there? Yep, right off the 0.79. And that's where my showtime, bears better come correct. Look how crazy this is. You can't make it up. Look at this. Just ever so slightly wicks into that bearish imbalance and discount. Done. Okay. Now we continue on. Now from this low here, boom, you'll notice right here, I said I like this low a lot. Golden pocket bullish imbalance on the higher time frame. Look where we are on the higher time frame. And this is the thing, the market is so fractal and it'll drive you fucking crazy because of it. There's your low to your high. Here's your retracement down into where? Discount, specifically the golden pocket, 62 to 79%. Here's that bullish imbalance. Price wicks into it. Do you see this? And took off. Did we take out a higher time frame swing low in the process? Indeed, right here. Check that out. And what was the first target? 14,979. Why would I say 14,979? Well, from this point, we did take out a swing low in the process. So it's only fair to play it, I guess you could say, cautiously. So where's 15,979? 979. Boom. Okay, right. Oh, it was that high. Sorry. Why would I identify this high? Well, market structure is technically still bearish, right? Even though we jumped like, 500, 600, or more, 800 points at that point. We still have the bearish imbalance. And at that point, I was quote unquote neutral. And the reason why I was neutral from that point is because I needed to see some sort of imbalance up higher to prove to me that we were actually going to continue this run higher. And we got it. So here's your imbalance that formed, boom. And now you saw, I want to see price sweep 15,468 swing high before a retracement, about 300 points. Here's your 14,468. This is the swing high, but in the process, what do we do when we take a swing high? See, bullish market structure shifts. So then we would go from our low to our high. Now, when am I waiting for this thing to retrace back down into discount? And I want to take this high, 16,264. So until then, I'm not looking for anything outrageous. So can you look at Tesla, please? Yes, I can definitely look at Tesla. I have Tesla shares actually. Walmart, can you look at NFEs, please? And thank you. Yep. How do you use these setups to trade FOMC or Fed speech? Don't. Stupid. No need to. Why risk that? You don't need to. Right? Yeah, you can get some pretty exaggerated moves, but do you need to trade it? No. Why not trade something much more highly probable, like we're seeing right here? Oh shit, we got less than a minute in this one too. How about this? Everybody in here, I'll chart out those names that you guys had just identified, and I'll post them in the group chat right now. Okay. But all right.
Question: how frequent are these classes that you help out here? Is it once a week or something?
No,
or
no. So I actually do them like 3 or 4 times a week.
Oh,
Usually,
sweet.
yeah. So Sunday is usually our weekly prep. Monday is usually concepts or review. Wednesday.